All right, despite market swings and poor economic data, my next guest says indicators are not pointing to a recession. In fact, he says stock valuations look extremely attractive. Well, Bill Stone is the chief investment strategist at PNC Wealth Management, where he oversees more than $100 billion, and he's joining us now live from Philadelphia. Bill, great to have you here on Fast Forward.
Thanks.
So we're hearing a lot of this, fund managers sounding quite bullish, analysts sounding somewhat bullish, but it sounds like investors are pulling money out of funds. Are you struggling with that really at PNC, having to talk to a number of clients and investors to sort of stay calm?
You know, we're definitely having to deal with, as you can imagine, clients are certainly nervous. There is more than enough, I guess, news flow to worry about. I think in terms of flows out, we really haven't seen that. I think we spent a lot of time trying to work with our clients on asset allocation. But you do know in the industry in general, just looking at mutual fund flows, that they have, at least certainly equities flows anyway, have been going out pretty steadily. So you know that some investors anyway are certainly at least moving toward the panic.
And as we speak about panic, what is considered diversity right now in a portfolio? What's a good way to diversify? I mean, clearly owning treasuries and gold has been a great bet, or two great bets.
Yeah, so far, honestly, that's about the only place to hide at the moment. I think one thing we track is, even within stocks, how much they move in unison. And believe it or not, the way they're moving so closely in unison is actually more than we saw during the worst of the financial crisis. So it's our way of kind of measuring how the macro kind of environment is impacting the stocks, that's really what's driving them back and forth. And usually when you get these extreme moves to the upside in terms of what we call the cross correlation, how they move together, usually that hopefully is some sort of sign that you're getting towards the end of it. It's always hard to know exactly how long that goes, but at least you know that's what's buffeting you.
What are you saying right now about equities? Are you recommending that investors get in here? It's a good point to be buying. It sounds like you think that they're actually, the valuation right now in the stock market is pretty attractive.
We do. I think two things. One is we went back and looked at, even though we don't think we're going to really go into a recession here, you have to say the downside risks have gone up. But when we looked at it, since early 1940s, you've really seen the average decline around recessions in the S&P has been around 22%. We're currently in that 15 and some odd percent range in the S&P. So some good amount of that has been discounted, though you could certainly see further declines. I think what we talk about is just really, if you really are looking at your baseline exposure to stocks, it does make sense, particularly looking at even long-term, the dividend yield being in excess of the 10-year Treasury, which doesn't happen very often. In fact, going back to the early 1960s, it has only happened a few times in times of real severe stress.
And Bill, let's talk about just a couple of years ago, 2008, a number of people now making comparisons to the financial crisis that started in 2008, saying sentiment is sort of at that same place. What are your investors, your customers and clients saying right now? There was a sense back then that, people at some point said, I'm pulling all my money out. I can't take the volatility. But do they feel that way now, or having weathered that storm, do they feel a little bit more comfortable?
I think it's always hard to say. Like I said, I certainly feel that they're feeling the stress and the volatility. I think, one thing that at least some things are different, and we've been able to point to some of those in terms of, we would believe that, again, the economy's in a better place to withstand some of it. Our thought has been out there for quite a while that we were unfortunately going to continue to see a bit of this, we call it rolling crisis. So I think in terms of maybe preparation in advance, perhaps a little better job done in advance of it. And I think, too, a lot of the, I call them weak hands in terms of people holding on to stocks have already moved away and never really come back to stocks yet. So maybe that leaves us in a little better spot as well.
Are there particular sectors you like right now, Bill?
I think in terms of sectors, I mentioned the focus has been on really dividend plays, and particularly ones that are sustainable. But in terms of sectors, a couple places to look, maybe consumer discretionary. That sounds strange. However, within there is like companies like McDonald's that have an above average dividend that we think can also continue to benefit. Healthcare, that's maybe a little bit of an obvious one, one being a little more defensive too, particularly in the pharmaceuticals group, having a higher dividend yield. Last is information technology. That one doesn't necessarily always have a higher dividend yield, but it's companies that have a real global reach and have continued to be able to grow and actually have the ability to over time raise their dividends.
All right, Bill, appreciate you joining us today. We got to leave it there. That was PNC's Bill Stone.